Hey, what is up everyone? It's David here. In this video, let's dive into Xero and try to answer the question, is Xero overvalued? Before I jump in, this is my framework of thinking when I'm analyzing companies to invest in. And I try to keep it as simple as possible. The first question is, how does the company actually make money? The second question, what are their historical financials looking like? And then the third question, what is their relative valuation compared to companies in a similar industry or field? I'll be weaving the risks they face throughout this video, but if there's anything you think I missed or I really should pay attention to, please let me know in the comment section below. As usual, you should never trust a random Asian dude you found on the internet. So this video is not financial advice or recommendation to do anything. It's just general information for entertainment purposes. By now, most of you would have heard about Xero in the past. And their core business is providing cloud accounting software to small to medium-sized businesses. Majority of their revenue is generated on a recurring basis, with bits and pieces coming from platforms or other services. Now, I use Xero for my own business, so I'm speaking also from a customer's perspective. And so far, the user experience is pretty damn good. But the crazy thing is, when I started my business, it wasn't so much about, oh, what software should we try and then commit to the software. It was more around, let's just start a Xero account. The amount of mindshare that Xero controls shows the dominance of Xero, especially in Australia. When it comes to competitors focusing on only cloud accounting software, MYOB is probably the other legitimate competitor here in Australia. If we look beyond Australia, then QuickBooks from Intuit is the other really dominant competitor in the US. So one of the ways to gauge market share is to use Google Trends. And you can see that Xero is leading the pack here with MYOB closely following, but it really seems like the gap between Xero and MYOB is really widening. I think it's a fairly accurate observation, but that's only Australia. Another key market for Xero is UK. In 2019, it seems like Xero have really started to distance themselves with their competitors. And looking at US, it's basically Intuit's market. So I'm not surprised to see QuickBooks literally destroying everyone. I'll talk more about the competitors in the valuation section in just a second. Okay, so let's take a look at some simple financials, and these numbers can be easily extracted from simply Wall Street. It's important to take note that Xero is a growth company. So their focus has really been going for market share, swing for the fences, then optimize for margins. Over the last 5 years, 2015 to 2018 wasn't that pretty, but they finally started to generate some earnings. Now, even though I don't plan to talk about macroeconomic stuff in this video, I think it's worthwhile mentioning just a little bit. We are heading into a rising inflation, rising interest rate environment. So because of that, it's likely it's going to have a little bit of a downward pressure on valuation. More on that in just a second. Looking at their balance sheet, their short-term assets well cover the short-term liabilities and the long-term liabilities, which really just means that they should have no problem handling any external shocks in the short term. But the crazy thing is that 500 million out of that $939 million of current assets is straight cash. So that gives Xero a lot of room to go out there to buy companies to grow even faster. Which is exactly what they did. They spent $241 million to acquire Planday, which is a workforce management software. On top of that, they spent $22.8 million on an invoicing software company called Tickstar based in Sweden. Now, both of these companies will give Xero access to customers in that locale, and also it helps expand Xero's total addressable market beyond cloud accounting software. Going back to the balance sheet for just a second, they did load up on quite a bit of debt since 2018, but because interest rates is so low, I am really not fussed about that. If you're worried about Xero's ability to pay their debts, generally what I like to do is to look at the operating cash flow against the interest expense of the company. Let me show you where to get that information. So I use Ticker to find information on both operating cash flow and also interest expense. And I left a referral link in the description box below if you want to try it for yourself. It's free at the moment and I am not sponsored. So the first thing you want to do is search for Xero in the search bar. And then we go to cash flow statement because operating cash flow is here. So we'll click on that and they'll chart the graph. And then what we want to do after that is we want interest expense, and that's an income statement item. So let me find interest here. So interest expense. So that should stack it together, and that will give you a good gauge in terms of how much
operating cash flow will be able to cover, how many times can operating cash flow cover the interest expense. And the higher that coverage, the better.
And the thing I like to remind myself is that cash flow generally doesn't lie, whereas earnings can be manipulated. So it's good to get used to looking at cash flow statement more often. Because this is a software company, let's dig a little deeper into their subscriber count and SaaS metrics as well. In their most recent half-yearly report, net additions have slowed compared to the same period in the previous year. To me, that's not a big worry since I think that this slowdown is mostly pandemic-induced. And I think that when the economy rebounds, then those metrics will snap back relatively quickly. At the same time, if we take a look at some specific SaaS metrics like CAC months, ARPU, or LTV per sub, they have all declined in ANZ, which is one of the core money generators for Xero. But it's really not clear to me whether the SaaS metrics slowdown is caused by the shutdown last year, or is it because Xero have recently increased the prices of their subscriptions. I'll talk more specifically about this in the future because I just think that their metrics need a bit of time to normalize before I can make more confident observations. I've written definitions for all of the different acronyms in the comment section below. So if you found that to be helpful, just gently smack that like button right there and leave a comment on what you think about Xero so far. Okay, cool. That's enough about financials in this video. Let's talk about the valuation before I answer whether Xero is overvalued.
So again, the first thing to do is to come to ticker, open up Xero, go to valuation, and then there will be a forward multiple versus a trailing multiple. So a trailing multiple is the last 12 months. So basically looking backwards. Whereas forward multiple is taking estimates in the future and then looking at that multiple. I generally like to look at the next 12 months, but it's a personal preference on my end. So if I click on this, then it'll show me what the historical next 12-month EV/EBITDA is. It shows you the mean, shows you the high, low, etc. So right now it's trading at a 97 times EV/EBITDA. So relatively, well, actually much higher than the mean. And we can drag this to 3 years as well. Now, if we want to compare Xero with other companies, what we want to do is we just want to add it over here. So let's say we add Appen. Now it's going to take a few seconds to load, but I've already done everything on this chart right here where I have added majority of the companies I want to compare it with. So let me turn that on. So Altium, Appen, WiseTech, Afterpay. I'll save Intuit for a little bit later because they are our main competitor. So let's drag it to 3 years to get a better view. And you can see that Xero is trading at a 96, 97 times EV/EBITDA. And it's quite high, as you can see, compared to all of our other tech darlings. And the next thing I generally like to look at after this is that if Xero is given a premium EV/EBITDA, is it justified by the revenue growth rate? And one of the ways to check is to go to estimates. And then I like to look at from 20 to 2022. And it seems like the analyst projections for Xero over the next 2 years is that they will grow by 20% compounded annually. That's cool, but what about other companies? Are they gonna grow at a similar rate? So I have some examples here. So if we take a look at Altium, it seems like Altium is expected to only grow by 0.8% compounded annually over the next 2 years. So a relatively small growth rate. What about Appen? Let's take a look at Appen. Appen's going to grow at about 9.9%. So I'm just basically going to estimates and check each of the tabs. I already opened them, so just to make it a little bit easier. And then look at WiseTech. WiseTech is growing much faster, estimated to grow at about 19.5% over the next 2 years. And Afterpay is going to have a crazy growth rate because it's Afterpay. And they are expected, mostly because of the US market as well, they are expected to grow at 72%. That's one of the reasons why, if you look at the comparables here, comparable tables, sorry, let me go back to valuation. You can see that Afterpay have a premium valuation just because their revenue growth rate is absolutely off the charts. And let's expand it to 3 years. And you can see that the revenue growth rate is, it kind of corresponds to the rest of the companies here. Now, I'll talk about Intuit in just a second, but you can see that Afterpay have one of the highest growth rate. Xero does have an amazing growth rate as well. But if you look at LTM and Appen, you can see that their valuation is not really trading at a relatively premium valuation, mostly because I think there might be some challenges with the business model and they're just not growing as quickly. So that's one of the ways to gauge relative valuation. Now, the thing is, Afterpay, WiseTech, LTM, and Appen, although they are tech darlings, they're not really operating in Xero's industry, which is cloud accounting software. So a better comparison is to look at Intuit versus Xero. So let me close the rest of the multiples. And you can see that this is more of a direct comparison between Xero versus Intuit. Now, Intuit is a massive software company in the US, and they do more than accounting software, but it's probably a lot closer of a comparison. Now, Xero looks like it's trading at a much higher premium compared to Intuit. But the crazy thing about Intuit's growth rate is that if we go to Intuit, right, go to the estimates, and then we'll look at the 3-year growth rate. Intuit is generating about 7 times the revenue compared to Xero, and they're estimated over the next 2 years to grow at 16%. That's insane. That's absolutely insane. And if we just go back to the valuation and look at the comparison between Xero and Intuit, they are trading at 2 different multiples, significantly different. But I will actually argue that the growth rate for Intuit is they're kind of on similar growth rate. There is a bigger question of, how will Intuit gain more market share, where Xero is still at the early stages of growth. But if we're just doing a direct comparison, you can see that Xero seems to be really, really highly valued at 97 times with about a 20% revenue growth rate over the next 2 years, compounded annually. Whereas Intuit is valued at around 31 times, well, almost 32 times, with a 16% growth rate.
So the key takeaway from that quick analysis is that when we compare Xero with our tech darlings here in Australia, it's trading at a higher or premium valuation, mostly justified by their higher than usual revenue growth rate. Afterpay is doing Afterpay thing, so we are just going to ignore their revenue growth rate. However, when we compare Xero to Intuit, which is their US counterpart, you can see that there is such a big valuation gap, and at the same time, Intuit is a much bigger company and still expected to grow at almost similar revenue growth rate compared to Xero. So personally speaking, even though Xero have a great business, it looks like it's growing tremendously quickly in both Australia, New Zealand, and UK. Unless I am high as a kite, I just think that Xero is just a bit too expensive for my own taste. But what do you think? Which part do you think I need to reevaluate when it comes to my analysis?
Okay, a portfolio update. As I'm recording this video, my CMC market portfolio is worth about 94,000 Australian dollars. And one thing I do want to point out is that I've made no changes on this side of the things. Everything is mostly the same. The one change I did make is that I have downsized my SPAC exposure by quite a bit over the last couple of weeks. Well, actually over the last week. And I've sold them down quite a bit just because I think that I got too excited. I didn't follow my own thinking when I first thought about these companies. I've done my due diligence on them. I still think they're quite good companies. I think my lack of macro awareness as well as not following my own rule. So my own rule, especially when it comes to building individual positions, is that generally I like to start with 1 to 2% of my portfolio. And then as my confidence increase, I'll just add more and accumulate shares. I didn't do that. What I did instead is I went for a bigger than usual position. And I felt like that honestly was just me being too greedy and got a little bit too emotional. So I want to document that mistake in this video just so that hopefully I won't make the same mistake moving forward into the future. On a separate note, because I sold down some shares, I have quite a bit of cash I need to deploy over the next couple of weeks, and I've deposited another $1,000 into the account. So I have about $8,700 I need to deploy over the next couple of weeks, and I'll keep you posted on what I do decide to do with that money. With my stake account is currently sitting at $40,000, including my buying power. So that's give or take approximately 50,000 Australian dollars. I have made no changes on this side, and I want to document these 2 positions here as well. Now, Porch Group is getting short sold. Short sellers are attacking the company at the moment. So that's relatively a big change when it comes to my purchasing price. And again, I want to document my thinking on this. And I frankly think that with these 2 positions, I didn't follow my rule as well. I didn't follow the 1% of my portfolio and then slowly build it up. I chose to go with a bigger than usual position. This is the price I have to pay when it comes to learning. And I didn't want to sugarcoat it. I just wanted to constructively criticize myself so that I learn from the mistake and move on. Now, as of recording the video, I'm not exactly sure what I'm going to do with these 2 positions. I might just hold it and not do anything. In the grand scheme of things, my portfolio is still growing, mostly because of my deposits, and I am still performing well in the sense that I am still up. It's just a tough pill to swallow, to be honest. I should have known better, but other than that, I still have cash I need to deploy. I'll keep you posted on where I decide to deposit that money moving forward into the future.
So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very, very soon.